Welcome to the Passive Income Podcast. I am your host, Dividend Dave. Please be sure to join the Passive Income Posse by clicking that subscribe button below. And on today's episode, I'm on Twitter at my own advisor. I'm going to throw it over to you, Mark, to give yourself an introduction.
Yeah, appreciate it, Dave. Thanks for having me. So I'm Mark Seed. I am my own advisor, and that's kind of a moniker to basically say I've been on my own DIY investing journey now for the better part of 15 years, and it's hard to believe it's almost been 15 years, Dave, since I've had the website. But I've been probably DIY investing a little bit longer than that, to be honest. But obviously, the blog is a bit of a labor of love, but yeah, happy to be here. I interact with a lot of DIY investors, readers, subscribers to my site. I also happen to run another website with my buddy Joe. It's a newer venture called Cash Flows and Portfolios. So you can find that through a quick, easy Google search or through my site. And yeah, just ready for you to ask me questions about my journey, my thoughts, Algonquin Power, Scotch, whatever you want to talk about, Dave.
We'll get into all of that, but yeah, right away, I do want to just bring up for those watching on YouTube, this is Mark's website, My Own Advisor, and you can see it there on the screen. And yeah, Mark, if you just want to talk more about kind of how you got started into, doing a website, and like I said, you've been doing it for nearly 15 years now. So I guess just talk to anything you'd like to talk about with this website.
Yeah, appreciate that. So I think My Own Advisor was really born out of my desire to just better understand my relationship with personal finance and investing. I mean, I was a DIY investor for the better part of the early, maybe mid 2000s, but I didn't have a vehicle by which to kind of chronicle my thoughts, to articulate some of our goals, and even just to interact really with a lot of other like-minded people. And so I started the website. It is very much a personal journey and story, but obviously over the years, I've been fortunate to meet and talk to CEOs and VPs of different companies, and I interact with all types of investors. It doesn't mean you have to be passionate about dividend investing. I mean, you can be a passive investor, you can be a private equity investor, you can be a real estate mogul. It doesn't really matter. And so I've had the good fortune of really interacting with a lot of like-minded people who are just passionate about investing. And the blog was obviously a vehicle for that. I said at the beginning there, maybe it's a bit of a labor of love, and still is. I enjoy this little passion project. It gets kind of my creative juices flowing. And so I'll continue to run it, and as long as it kind of inspires me and motivates me about our financial independence plan. And so far so good. And it's great that people visit and add comments and give me inspiration for new content.
A lot of people, 90,000 plus visitors each month. That's a very large audience. That's great.
Yeah, it's been awesome. I mean, the site's been growing organically, kind of year after year, and I hope it continues. But at the end of the day, it's really nice to interact and engage with, like I say, like-minded people, and to have a bit of a story to tell as well. And if that inspires other people, or even if it, causes people to say, you know what, I don't really like that investing. It's not for me. I want to think about this. Or I want to do things differently. I mean, that's totally okay too, right? And constant refrain, Dave, like personal finance is personal, right? So.
As you can see, for those watching on YouTube, there's quite a few different things to click across the top of this website, and I'm sure, well, I know there's a lot to dig into through this website and a lot to learn. So yeah, that's awesome. That's amazing. 90,000 plus visitors each month. Wow, that's great. And it's great that you're, like you said, it's still a labor of love for you. So, you're not getting bored doing it. You still love doing it, and you're passionate about it. So that's amazing. That's where you want to be, right?
Yeah, totally. I mean, it's interesting because, the early days of the blog, they were very short posts. They were more just about individual securities or investments or things like that. But then, my thinking evolved, and I started talking a little bit more about our journey and, our income journey in particular, in terms of trying to achieve some level of financial independence, or some semi-retirement dreams, if you will.
Yeah.
And then over the years, it's kind of evolved to, okay, well, what about taxation, and what about life insurance or other considerations you need to think about as part of that whole personal finance pie, right? So it's really evolved, and now I'm more thinking about kind of these semi-retirement plans. And so where my income's going to come from? Is it going to come from stocks and ETFs? Is it going to come from being an entrepreneur? Is it going to be coming from a part-time job or jobs? And I'm kind of going through this evolution of wouldn't say redefining myself, but like, who am I? I'm not a full-time maybe employee in a few years. What am I? Am I a part-time hobbyist? Am I a
You're getting to the
part-time?
point of work optional.
Yeah, exactly. Am I a golfer? Am I, do I enjoy the craft beer tasting on the weekends, whatever it may be, right, Dave? So I'm trying to
We'll definitely
think
talk
of,
about golf and beer and
yeah,
hockey and other stuff coming up here, so stick with us for that.
yeah. So anyways, it's all about kind of designing our lifestyle a little bit, right? And just trying to figure out what's next. So it's a cool process.
Awesome. So, for those of you watching and listening that don't know, Mark is also in Ontario, Canada, as I am as well. So, we will be probably talking about a lot of the Canadian market. Okay, now that all the Americans have clicked off, let's get into some of the different sectors, Mark. As so many of my viewers know, REITs is where I love to start. REITs is kind of one of my favorite uh, sectors because I love the monthly dividends. I love having that exposure to real estate without being the landlord. I have to deal with the 2 a.m. phone call. I don't have to hire a property manager. I don't have to do anything. They pay me to not work for them, right?
Absolutely.
So I guess my first question is, what is your favorite REIT and why is it RioCan?
Well, I mean, I wouldn't say it's RioCan per se. I do hold it, so you've been sleuthing on my site a little bit, but it's a really small position, Dave. To be honest, it's kind of a legacy thing that I bought years ago. I
Yeah,
would probably tilt a little bit towards Canadian Apartment REIT. So CAR.UN
yeah,
is one of my more favorite REITs, to be honest, just because the growth story's been there a little bit more than the RioCan. Um, and it has. I think it's been, if I look at 5-year charts, I want to say maybe the returns for Canadian Apartment REIT are probably about 30% over the last, like overall, like total return over the last 5 years. So that's not too bad given where the economy has been with COVID and stuff. But
right.
yeah, RioCan's a bit of a legacy position. I don't know a lot, but I would say if I had to pick a favorite REIT and one that I own, and then one that I continually reinvest the dividends on in my some of my registered account. Yeah, I would probably pick CAR UN, to be honest. But to your point, Dave, um, being able to invest in industrial or residential real estate or other types of real estate, office, what have you, commercial,
Yeah,
without actually owning the property directly, I think REITs offer that income. They also offer a little bit of capital gains, right? A little bit,
yeah.
depending on the company, of course. But they also kind of give you um, a different flavor. They're not quite a stock and they're not quite a bond, right? So
Yeah.
they give you something a little bit different. So I can see the allure.
So first response there, yeah, CAR, Canadian Apartments. That's been on my watch list for an extremely long time. I've yet to pull the trigger on it. Yeah, that's definitely one that I can see why that would be a high in your favor. The reason, one, not the reason, but one of the many reasons that I'm so high on RioCan is I was born and raised near Kingston, Ontario. And about 15, 20 years ago, RioCan took over the old Nortel property theater, Home Depot, restaurants, retail stores. It's just a massive complex. So basically, when I drive by that RioCan Center in Kingston, I just feel the pride of ownership, right?
Yeah, I mean they're expanding, right? I mean they're going into more mixed use. And I would say they're not just residential, but they're obviously commercial as well, right? So they do own the
Yeah, yeah.
the commercial footprint, right? So the box store kind of plazas and stuff like that, but they also are building more residential real estate around those box stores, right? So you can kind of, I think their thinking is, without kind of going back and reading all their website and kind of their agenda of sorts, but it's kind of, a little bit of work and play and live all in the same area, right? So I think that kind of could potentially propel them. Again, could, who knows what the future is?
Good.
I always say
Not
that.
financial advice. We don't know. We don't know what the
Yeah,
future holds.
the
We're just
financial
a couple
future is
guys
always
talking.
very cloudy, but at best. But yeah, I mean, that could be a growth story for them, right? Is that they're obviously offering the opportunity to kind of work, live, and play all in the kind of same area, if you will, right? And they're building, I think,
Right.
some assets around some, at least in Ottawa, at least where I live, they're building assets around, uh, transit hubs and LRT hubs and those types of things. So yeah.
Any other REITs that grab your attention or you have interest in?
You know, I think coming into COVID and during COVID, I did own some kind of industrial REITs. So there's a couple, like I think Granite would be one, and
Yeah.
there's also Summit would be another, and there's obviously a few others. But um, to be honest, I repositioned some of my assets just to be a little bit more uh, passive. And then, I've been on, you can check my website. I've got a couple posts around lessons learned to diversification and those types of things. And, at some point you get into, I would say, a little bit of diminishing returns depending on the number of assets that you hold. So,
Right.
if you're owning 4 or 5, 6, 7 REITs or what have you, are you better off maybe just buying the REIT ETF and paying a small nominal fee, because it's hard to hedge your bets really on any one stock, because that's kind of what you're doing, right? Is if you're a big RioCan person, or you're a big Granite person, or you're a big any person, if you will,
Any.
right?
Yeah.
Yeah, you're obviously making a bit of a speculation on the long-term growth of said company, right? And that could work out very well, but it could also kind of work out not so well. And so that's part of the challenge, I think, of being strictly a DIY stock picker, whether it's REITs or any other sector that we'll talk about, is you're hedging some bets on an unknown future. And if they work out, that obviously works out well. But um, yeah, if you're getting into, you know, every single REIT possible, or you might as well just buy the collection of them and pay the wrapper fee that is the small MER for that stuff. I haven't done that myself, but I know, there's pros and cons of that approach, of course.
Yeah. You're making me feel like I probably have too many REITs. I have like automotive properties. I have Northwest
Mm,
Healthcare. I have EXE. I have TNT. Probably more. Those are just the ones off the top of my head, right? And obviously RioCan as well. So
yeah. Yeah. And I mean, every person's different. I mean, it doesn't make it wrong. It just means it's potentially, um, obviously a little bit more risky in owning some individual plays. But at the same time, once you get into owning too many of them or lots of them, you're basically creating your own index of sorts, right? And that's okay
yeah,
too. But pros and cons of that too, in terms of rebalancing, and then which one is kind of the leader of the pack and a little bit more oversight. So yeah, pros and cons to it all, Dave, as you well know.
yeah, for sure, for sure. You did mention energy, so let's talk about. And you did mention Algonquin Power as well, and we all know what
Mm,
happened with the dividend cut last week. So let's dive into the energy sector and Algonquin Power in particular. And what do you think's going on there? Obviously, there's lots. I saw a lot of tweets last week about the management and how the management needs to be replaced, or something has to happen with management
mm.
to keep Algonquin going forward. Yeah, just what are your thoughts on Algonquin Power, and well, let's start with Algonquin Power and we'll go from there.
Yeah, sure. So uh, the short answer is, they've obviously been over leveraged, right? So too much
Yeah,
debt and maybe too many ambitious plans. And I think interest rates and other types of macroeconomic factors have caught up to them, without getting into too much detail for everybody. But certainly a dividend cut is not helpful. I mean, it's not something that any DIY dividend investor would want in their portfolio. That said, it
no,
can and could happen, right? And I actually wrote about that in a recent post on my site, right? I kind of put my collection of thoughts around, dividend cuts and what that means to me personally, but also what I plan to do with Algonquin. But coming out of this long term, the way I see it, Dave, um, dividends are just part of a total return, right? So they're not the be all end all, right? So you obviously want, maybe as an income investor, you want some dividends, but you obviously hope you get some capital gains too, right? Otherwise, if you're just getting a dividend, you're not going to get the growth. And so obviously you want the best of both worlds. You want both, but it's really hard,
Yeah.
right? So with dividend and capital gains kind of being two sides of the same coin, it's really hard to get a lot of both. You kind of have to have a little bit of each or pick and choose each one. Um, I think with Algonquin, by cutting their dividend, what they're doing is they're obviously freeing up cash that isn't being paid to shareholders, and they can obviously do other things with the business for that. And I think that's smart. So hopefully long term,
Yeah.
we would see the Algonquin price go up. And it's not surprising, I don't think, that it's going up post last week's announcement. And it should continue maybe to go up as long as the company is very transparent and organized in terms of their mandate about what they're doing. But yeah, short term, there's definitely going to be some pain and probably some market volatility. But I do see dividend cuts sometimes as helpful to basically just have the company do a bit of a reset. I think Disney did that, right? For your audience in the US, right? Disney cut their dividend, I believe, and it was a passion stock for a lot of people in the US and otherwise. And it's like, oh my
Yeah.
gosh, the sky is falling. Well, maybe that's the right thing for management to do, right? And so all that said, there's lots of ways of getting total return. It's not just about dividends. It's about maybe doing share buybacks, paying down debt, acquisitions. That's popular in the tech industry. So dividends just happen to be one popular and maybe gravitating form of rewarding shareholders, but it's not the be all end all.
Yeah. So to that point, I've had a couple of MX that I've spoken with over the past couple of days where they kind of compared the Algonquin Power dividend cut actually to the AT&T dividend cut,
Hmm.
where they were like, okay, you know what? We're still holding it. The dividend cut sucks. It's not great. We don't like dividend cuts. We like that passive income rolling in every month or every quarter, whatever it may be.
Yeah.
And but at the end of the day, you want that company to be stronger. And I don't know the exact sentiment with AT&T if it is a stronger company now since that dividend cut, but I do feel, me personally, this is just again my personal opinion, not financial advice, where I'm looking at Algonquin Power saying, well, where's this company going to be in 5, 7, 10 years? And are we going to look back on this January 2023 dividend cut as just a blip on that 10-year chart where, and like you said, the price is going to start to hopefully appreciate again, as it should, right? Another point I want to make to that is, I don't know if you saw it or not. I put a tweet out last Thursday when that announcement was made, and I was like, okay, right now everyone is fearful of Algonquin Power. Is now the time to be greedy? The price is low, right? Like, is now the time to be buying up Algonquin Power like crazy, or are you still like major red flags? I don't know. Kind of, what are your, obviously you know what I'm referring to
Hmm.
with fear and greed, right? So, kind of, what are your thoughts on, is now the time to be fearful or greedy with Algonquin Power?
I really think the answer to that depends on your thesis. I know your personal investing thesis, right? So if you believed that it was a good company before and they just ran into a couple bad quarters of trouble and got their forecasts and some of their estimates off, maybe there's not a big reason to sell everything. And that goes for the ATT stock or any of the stocks. So I think you have to go back to the reason why you bought the company in the first place. Is
Yeah,
what is maybe your personal conviction or hedge on that financial future of that company. Um, the flip side is, if you're really just focused on maybe higher yield, which are red flags and warning flags for that, right? Because dividends can get cut from these higher yield companies. Again, two sides of the same coin. Dividends or total return or capital gains. You can't really have both of each. Um, then you may just want to say, you know what, if my thesis is I only invest in dividend paying stocks, I want to have stuff that pays in a 3 to 5% range. I don't want to own anything else. That's okay. That could be your personal conviction to unload that particular stock, right? Because they have cut their dividend. So I think it all comes back to your investing thesis.
yeah,
I think it's hard for a lot of investors, unless you're a true passive kind of index investor in broad market, low cost ETFs. to kind of just to kind of square away with what is that thesis, because your emotions get kind of tied into the equation, right? I
Unfortunately.
personally, yeah, I mean, I personally have kept a little bit of Algonquin power just because I don't see, while we're still on the subject, I don't see where, because most of the business is a regulated business, right? You have income coming in from that regulated side of the organization. Um, I just don't see how that's going to bottom out near term. If anything, the need for those services will only grow. So, um, yeah, not advice. It's not what other people should do in terms of buying more or keeping their holdings. But I think it all boils down to your investment thesis and why you bought the company and why you should and or sell the company in the first place, kind of thing.
Yeah.
Yeah,
I never had a huge position in AQN to begin with, so I'm like, I'm just going to hold on to it and kind of see where it goes.
fair enough.
While
Yeah.
we're in the energy sector, any other thoughts on any of the other major players, Enbridge or anyone else?
Yeah, I mean, pipelines have always historically in Canada paid out quite a bit of their their cash, right,
Yeah,
to shareholders. So that's not uncommon. So the yields on Enbridge are fairly high, but that's not surprising. And so same with TransCanada and maybe Pembina, kind of being the big three in Canada. Um, I'm not too concerned personally about any one of those three. Enbridge is getting a little bit high, and certainly, I would like any company that I own as a shareholder focused on not only rewarding shareholders, but again, doing it the smart way. It's not all about dividends. It could be about buybacks, which it's getting more expensive to do that. But I would say energy overall, Dave, I'm somewhat bullish on it for this year, just like I was last year when I started, positioning my portfolio during COVID, like early days of 2021 or even 2020, to be a little bit more energy focused, just because, yeah, all the signs were pointing to that. So not to say that I certainly timed anything perfectly, but I don't see a world in 2023 where energy bans are probably slowing down. It's probably still going to be probably a pretty good year for energy, but who
right.
knows? I didn't see it going up, whatever the sector went up like 40 or 50% last year, but it did. So yeah.
Moving on to another uh, topic that all of us Canadians love to discuss is the Canadian banks.
Hmm.
And I know I shared that tweet with you from at Settling Nomads. I'm just going to try to find it here to bring it up on screen. It is from last October, so it's beginning. The yields in it are beginning to get a little bit dated, but that's okay because the meat of the tweet is all about the longevity of the Canadian banks paying dividends. I guess let's just dive into the Canadian banks. What are your thoughts?
Yeah, in terms of this sector, I mean, I've always tried to keep a few Canadian banks and just financials in general in my portfolio. I think, to your point, they've powered the economy here for quite a long time. You've got up the screen there. Yeah, I mean,
Yeah,
essentially, um, I'm a shareholder in many of those companies, and I have been for the better part of pretty much 10 years, if not more, for almost all of them. I think recently Morningstar might have put out something where, three or four of the Canadian banks are probably in a very small class of companies over the last 20 years or so that haven't cut their dividends. There's obviously a few others in the mix, but Canadian banks tend to be the part of the backbone of our Canadian economy, and I don't see that changing anytime soon. That being said, and I know you had Dividend John on here recently, who's a
yeah,
big fan of Canadian banks. I would be a little bit concerned about going more, all in. I'm not saying, other guests are putting too much into any one sector. That's obviously their totally their choice.
yeah.
But I would be leery about going too heavy into any one sector because, like I mentioned earlier, I think some of the things that can make you wealthy are the same things that can make you poor, by just kind of going all in on any one stock or any one sector. So I'm a little bit more cautious. I don't have more financials other than maybe what the broader low cost index has, which is like what, 20%, 25% financials. That's kind of my happy spot. But again, everyone's different and everyone's tolerance for risk is different. And so on and so forth. But I can't deny the longevity of certain financials paying a consistent dividend, and in a lot of cases, a growing dividend. I mean, the evidence is there. So,
Exactly. Yeah. Just quickly, I was actually DMing with as settling nomads actually just a day or two ago, saying, "Can you send me that tweet again?" Because again, it's from last October, so I was trying to scroll through his page, and I'm like, "Oh, he tweets like 15 times a day. I'll take forever to get back to October." So he was kind enough to send it to me. So shout out to at settling nomads. But you can see there on screen for those watching on YouTube, Bank of Montreal paying a dividend since 1829. So 6 years from now, that's a 200-year anniversary. Bank of Nova Scotia since 1833. And what's the next one? 1857 for Toronto Dominion. CIBC at 1868. And Royal Bank, the biggest bank in Canada, being the baby at 1870. But all now well over 150 years. So, yeah, the longevity of those dividends being paid is you simply can't argue with it, right?
yeah, very much so. I mean, the evidence is there. Now, again, you could argue this two ways. History can be a very good teacher, and it can be a decent predictor of kind of future events. But at the same time, like I said, from a risk management perspective, you just need to be mindful that kind of going all in on any one company or any one sector does have those kind of concentration risks. And I think that's something
Yeah.
that all investors need to think about. I'm not just saying that about Canadian banks. You could say, all about the FANG stocks, right, from the US, whether it's the Facebooks and the Amazons and the Googles and the names.
Yeah.
You know, everybody looks like a winner when the market's hot, and these things are having multiples, and they're running up in price over time. But that's not always going to be the case, and there is going to be a time where things revert to the mean, and the growth story is going to be very growth oriented, right? And there's going to be a
There's
trailing
always a
effect.
pullback no matter what, right?
Exactly. And I don't know when that's going to happen, and I can't predict how big it's going to happen, but we kind of know it will happen at some point. And so those are some of the risks that investors need to think about.
Yeah, for sure, definitely. Let's move on to another sector. Great points about the Canadian banks and everything there. So, telecoms, telecommunications. Obviously, here in Canada, we have the big three: Bell,
Mm.
Telus, Rogers, and I guess I don't even want to say to a lesser extent, Quebec or is getting quite big as well. I guess thoughts on I guess first thoughts on Bell and Telus, and then thoughts on the Rogers Shaw potential deal takeover merger takeover.
Yeah, I mean, I'll tackle that one first. I think it's still up to the regulatory bodies of the day, and I think it probably is going to get even more drawn out than not. But that's just a hunch, just knowing how long these things takes from a
Yeah.
from a competitive landscape environment, especially when there's only a small number of players in Canada to begin with. And to that point, I do have a little bit more of a bias, as do a lot of other DIY stock investors, to the Telus and the Bell. They seem to be very well managed. They seem to be doing a lot of things um, right in terms of community involvement, and just thinking about broader you know corporate social responsibility, sustainability issues. Right, they seem to be kind of leading the forefront, and so that's appealing to me as a shareholder personally. But it's not to say the Kojikos and some of the other companies can't be yield positive returns for you as well. But I do like, based on our previous chat there around the banks, I do like the board of directors kind of guidance that comes out on Telus, and their commitment to kind of rewarding shareholders that way. And Bell has historically had a modest to higher yield, which they seem quite committed to paying as well. As well as providing a longer term growth story as well. So yeah, all good in my book. But again, probably don't own tons of telcos in terms of the assets, right? I don't know if they make up even 5, maybe 6% of my overall portfolio, but it's certainly part of my positions for sure.
Yeah, no, good points. I think you're obviously the telecoms in Canada, they're very strong companies. They've been around for ages. So, and we don't see them going anywhere. Like, Bell Canada and Telus and Rogers are all still going to be here 10, 20, 30, 50 years down the road, right?
Yeah, I think there's just a big barrier to entry, but that's not to say that other companies may not come in and be a bit of a disruptor. But near term, I wouldn't say there's a lot of huge risk in owning one of those telcos. But long term, yeah, I mean, again, future's always a little bit financially cloudy,
Yeah.
but yeah, I mean, they've been historically very, very good companies to own, and they've rewarded shareholders, accordingly.
Cool. Let's get into the next sector that I love to discuss because it's food, consumer staples. And oddly enough, just last night I put out a random tweet about, hey, just give me some inexpensive recipe ideas. So obviously I'm in the DivTwit community on, my name on Twitter is Dividend Dave, and I follow all the dividend investors, and they follow me back. And yeah, so this random tweet about food is by far my like it's closing in on 100,000 impressions right now. And I'm like, okay, so everybody loves food, right? So let's
I,
talk
yeah, I mean, we all have to eat, right, Dave? So
exactly.
yeah,
So
so
what do you love in the consumer staples sector?
yeah, I mean, there's big players in that space, right? There's obviously Loblaws that's getting a lot of press, maybe not so positive press lately, just around the food inflation story and
Yeah,
so on. Metro has been historically a lower yielding stock, more of a growth oriented stock, but that has also rewarded shareholders. So, there are a couple of the big names. I think Empire is also, they have oversight over, various franchisees and
yep,
chains as well. So, there are a couple big players, not unlike the telco space, where it's being overseen, if you will, by a handful of players who tend to have fairly wide margins, if you will, not profit margins, I'm saying, but more margins and higher barriers to entry for any kind of newcomer coming in. But I would say, from the grocery kind of side of things or the consumer side of things, the sector has never been really huge in Canada from a market cap perspective.
yeah,
But certainly, if you look at the historical returns from some of the companies I just mentioned, yeah, I mean, they've tended to serve shareholders quite well from a total return perspective, and that's kind of hard to ignore.
yeah, agreed. Yeah, and they've definitely been in the news, the Canadian grocery stores and the grocery store chains, like you mentioned, Loblaws, Metro, Empire, and kind of for the wrong reasons. It's like, oh, inflation is at an all-time high, and these grocery stores are announcing record profits, and it's like, something seems wrong here. Like, why are we paying so much more? And you guys are, great for investors, not so great for the individual consumer, right?
Yeah, I mean, on that topic though, I mean, I think food inflation is it's probably a few trigger words for a lot of folks, but the margins themselves, by and large, are really based on volume. They're fairly thin if you really dig
Yeah,
into the math. They're quite thin for a lot of the grocers, meaning, you know, sure, you could find the odd example if you look, and there's lots of interesting things on social media. So don't believe everything you read on Twitter by any stretch, hopefully, folks, and
or
don't believe
anywhere on
it
any social
or
media
anywhere on any
platform.
social media, exactly. But by and large, the margins are quite thin, but you get it by volume, right? So
Yeah,
that's just something to keep in mind when you see politicians and other people kind of pontificating about some things. It's not always what you think it is until you dig in. And there's lots of folks that have done a much deeper analysis on food inflation and other things. But yeah, like everything, take anything you see online these days with a little bit of a dose of realism, and do some
and a
fact
grain of
checking.
salt, right?
Yeah, do some fact checking. Exactly.
Several grains of salt. While we're
Yes.
on the topic of consumer staples, let's hop across the border and kind of thoughts on Walmart, Costco, Coca
Mm.
Cola, Pepsi. The kind of the I almost call them the big four, right? In that consumer staples category.
Yeah, I mean, it's hard to argue with Pepsi's total returns over the last 20 years if you can look up some charts on that. Coca-Cola hasn't really been as strong, but I think Pepsi has the whole kind of snack division and
Yeah,
other kind of brands, and there's tons of them. Um, I don't own either, actually. I am a fan of the Walmart stocks and maybe some of the other industrial stocks in the States, like Waste Management and some other companies, because I just find they're more defensive, but they're also a bit air quote recession proof. I mean, everyone's got to brush their teeth. Everyone's got to take the garbage and the recycling out. It's got to go somewhere.
Hmm.
Um, certainly from a Walmart perspective, they are a low cost leader, but they're also getting more into the kind of online commercial space as well. So they are kind of a bit of a moaty stock from that perspective, and I kind of like that kind of angle from the U.S. Now that doesn't mean things can't change with any of those companies over time, but
For sure.
they do have all very strong brands, and so those are things that I kind of tend to gravitate to in my personal portfolio. But like folks that read my site, other than a few stocks here and there, I'm more or less an indexer, if you will. I invest in the low cost ETFs that own hundreds, if not thousands, of stocks, and I don't have to really pick and choose that way. But I do have some favorites, and I have some
Yeah.
conviction in those companies for lots of reasons.
Yeah, no, and obviously ETFs are a great way to go. You get this nice little basket of different companies, and y- you probably sleep well at night knowing, hey, this ETF is managed by professionals, and say it's got 15 companies within that ETF, and if one of those companies isn't performing well, it gets booted out, and they bring another one in to replace it, or whatever, or however, whichever way that whatever ETF may be managed. Obviously, they're all different, but you kind of one of those almost set it and forget it.
Yeah, pretty much. I mean, you really just have to think about adding assets, like adding your buying more units over time, right? Whether that's lump sum investing or dollar cost averaging. And I got a few articles on my site about which is better historically, statistically, et cetera. But yeah, I mean, when in doubt, go passive if you can, right? It's not the full on approach I've taken for a few different reasons, but that absolutely doesn't mean that it's not a great thing to do. But it does take also that investing discipline too, to stick with the program, if you will, when things are down 20 or 30%, right? And the sky is proverbially maybe falling, right? So
Right.
there's all these behavioral factors that kind of go into how you invest and why you invest, which is probably another podcast, um, Dave, which is all good. But yeah, I mean, I do like some U.S. stocks for sure, and I've had them for many years in some cases.
Cool. So you mentioned waste management and industrials, and as soon as anybody mentions industrials, kind of pretty much my first thought is Caterpillar. And
Mm,
well, one of those reasons is I've worked for years in the construction industry, so like I've operated so many Caterpillar machines. They're amazing excavators, skid steers, and well, the list goes on, as I'm sure you know.
right.
Um, any other thoughts on anything in sort of the industrial sector or Caterpillar in particular?
Yeah, nothing too much to talk about Caterpillar, but I agree with kind of where you're going, is that there are some market leaders, and it's hard to argue with the success of some of those market leaders in certain sectors. And so,
Yeah.
you know, one thing that investors can do, if they whether they want to start investing in individual stocks, again, personal choice, or whether or not they want to stay passive, right, with broad ETFs, low cost ETFs. That's obviously more than fine too. But one of the things that we were talking about, a theme today, is just kind of that index skimming thought, right, where you're kind of looking at leading companies in demand sectors, and what's their established history of growing their earnings per share, what's their cash flow been looking like, Caterpillar or otherwise. And so those are kind of metrics that you can kind of look at if you choose to be a DIY investor, and if you choose to do some individual stock selection. Those are some of the ways and some of the proxies that you can use to just think about these companies. But again, not a must. But I would assume a lot of DIY investors do similar due diligence, and that they're looking at some higher earnings per share, higher cash flow, hopefully lower debt, maybe the planned acquisition companies over time, and looking for that growth story before they make any individual stock purchase. Caterpillar, Waste Management, railroads in Canada,
Yeah.
banks otherwise, right? Yeah.
I was gonna bring up railroads. I don't know if anybody can hear, but behind me the trains are going. So I'm not sure if anyone can hear that or not. But yeah, obviously you're 100% right. The railroads in Canada, I've had several Canadian guests on who are huge fans of CNR and CP. And yeah, I look out my window every day going, I should own that company because I just see it every day, all day, every day.
Yeah, I mean it's hard to get stuff around the country as big as and vast as we are, and for that matter into the US and Mexico
Yep,
without having a network, right? And it may even increase over time, right? Like sure the plan is to have EVs and other types of kind of trucks and infrastructure on the roads, hopefully in the coming years to reduce our environmental footprint and be more socially responsible and the like. But that transition may take 5, 10, 20 years, right? If
or
not more.
100. We
And
don't
so
know, right?
we don't know, but with that technology, are there ways where we could, have the locomotives be a little bit more environmentally friendly and still ship the
Sure.
volume of stuff that we need to get around the country in a kind of an efficient, effective way. And it's really hard to replicate that rail network, right? And you look at
Yeah,
maps, do a Google search of CNR, CP, and you just look at their infrastructure map and you see where all these rail lines are going. And you're like, wow, okay, that's how I get
impressive,
my
right?
good. Yeah, that's how I get my goods and services, right? And sure, it can come from a plane, it can come from FedEx, it can come from other ways, but yeah, the rail network is essential, and our economy wouldn't be what it is without it.
Oh, definitely
So,
not.
so I can see why your other guests are pretty bullish and probably happy shareholders of CNR or
Yep.
CP, and I could see those companies continue to do well for maybe long after I'm around. That's for sure.
Yeah. Well, they were here long before we were, and they will, odds are good they will be here long after we're gone as well, right? So
Yeah, chances are.
just like those Canadian banks, it's 200 years. I was not here 200 years ago. I will not be here 200 years in the future, right?
Yeah, if you find a way to do that, uh, let me know your secret, Dave. So
Right. Um, Technology, obviously, we've been lacking in the technology sector in Canada. You look to the US and you look at Apple and Microsoft, and I even throw Tesla in as a technology company. I just was speaking with Barry Milligan a couple days ago. He's in California, and he was like, "I'd even throw John Deere into the technology sector." He's like, "Have you seen a brand new tractor these days? It's full of technology." And I'm like, "That's a great point." And Canada, we've since Blackberries went the way of the dodo bird, we've all really fallen behind in the technology sector. I guess just sort of any thoughts on the technology sector as a whole, or anything in the Canadian technology sector that you're keeping an eye on?
I mean, not personally. I mean, most of the big tech that you are aware of, and I'm sure all your audience and followers are aware of, is U.S. based. So it's the FANG stocks, and it's all the
Yeah,
ones under the kind of the Nasdaq 100. So kind of as a fund, I tend to own that one and have for a while now, just because I find I don't have to pick and choose between is Google or Amazon going to be the biggest company in the world, or Microsoft. Um, Certainly, maybe over time I'll hold some of that individually, but right now I like being really lazy and just owning a fund that holds all those stocks and then some, and
yeah,
I don't have to pick and choose who's going to be a winner. So that's really just a total return play, obviously, right? I'll take whatever that collection of stocks gives me, and I just ride whatever that index will give me. But to your point, I mean, we had Nortel back many years ago.
yeah,
Highs and lows, well chronicled, well documented. Shopify was a darling for a while. There's a few other companies that are continuing to be doing really well. But our technology space is quite strong. I guess a bit selfishly, I would love to see tech and fintech and more companies kind of advance in Canada. I think it's good for our economy. I
for
think
sure.
innovation is always helpful for a competitive marketplace. Um, but yeah, there's only a handful of players right now in the tech sector. But again, there may be a lot of them in the pipeline through the venture and other kind of exchanges that we just don't know about yet, or they haven't been well publicized yet. And they're basically on seed money and venture money right now. And so who knows what's going to happen in the next 5 to 10 years. Um, Tech moves fast.
Yeah,
AI's coming faster than I think a lot of us think it's coming, and being
Yeah.
part of our daily lives. And so there could be a lot of positive tech stories in the Canadian space. And like I say, I hope for our Canadian innovation and avoiding any sort of brain drain. I hope it'd be nice to see that in our economy for sure.
Yeah, when you said AI, my first thought was obviously GPT, which already seems like it's going to be the biggest story of 2023, right? It's all of a sudden you're seeing, tweets and headlines and whatever about it everywhere, and it's like,
Mm-hmm.
okay, AI it's coming and it's coming fast.
Yeah, absolutely, and it's hard to wrap your head around all the possible solutions or opportunities for that. But I'm sure there are a lot of people working um, a lot of late nights and weekends trying to figure out how they can capitalize on AI technology and
Yeah.
bring different solutions right to the market. So yeah, stay tuned, watch the space, whatever kind of moniker you want to use. I think the next few years are going to be really interesting.
I I don't know what he's barking at, and I apologize.
No problem.
Hey, oh my goodness, did you see me jump? He scared me. He was just laying
Yeah,
there, all calm, and then he just
yeah. You
decided to.
him barking and you jumping scared me too, but it's all good. It's all good.
So you wanted to talk about some other things. Let's talk about Scotch, which is very interesting because again, going back to Barry Milligan, just the last guest I had on, we ended up talking about the sin sector and sort of alcohol, tobacco, marijuana, and you did say in your DM to me that if you want to talk about Scotch, let's go for it. I'm not a huge person into hard alcohol. I tend to like my beer, but um, I guess let's try to tie it in, like anything with, within anything within that where you would invest in, say, Seagram's or Molson Coors or anywhere in there, or what do you like about Scotch,
Well, I
both
mean,
taste wise and investing wise?
yeah, I mean, the short answer for the investment is I don't own any of those kind of sin stocks. I mean, I guess I do own them indirectly through low cost ETFs, right? So I kind of own them by
Yeah,
default, as would any investor that owns some low cost ETFs in the U.S. market. But that aside, it's just a tasty drink. I mean, it's one of those kind of treats where once in a while it's just really nice to have. I've been fortunate to travel to Scotland a few times. So you can't call it Scotch outside of Scotland. Call it whiskey or other things, whatever you want. But Scotch. It's probably an acquired taste, and I wouldn't say my palate is super refined, but it's nice to have. So for those that are watching that enjoy the odd dram of Scotch, which is a small pour, um, yeah, I mean I'm a big fan of probably Islays. So Islay Scotch, they're a little bit smokier, they're a little bit peatier. Um, I don't mind the Speyside ones. I think Dalwhinnie is probably one. Sorry, not Speyside. Macallan's probably one in the Speyside area. That's pretty good. Um, but yeah, I think for folks just starting out, um, you could probably start with maybe a Highland maybe or something. That's another region in Scotland. They tend to be in maybe a little bit more like a heathery kind of flavor to them. I got my little notes here, maybe a little bit of honey or citrus. So they may just be a nice, easy way to kind of ease into it. But definitely the Islays are my favorite. Got a couple brands. Um, have it for special occasions. And yeah, just a nice small little dram once in a while to celebrate a milestone or something. But yeah, it's just one of those things where not everybody's into it. Um, and some people abstain, some people have craft beer, some people like wine. That's all
yeah.
good, but the odd little dram once in a while is
To each their
yeah,
own, so to speak.
yeah. It's just one of those things that I've acquired, and yeah, it's just one of those little treats.
Okay, so you said you've been to Scotland to sample the Scotch, so let's talk about golf as well. Did you get to play the old course?
So I haven't played the old course. I got a couple pictures behind me. One of Ben Hogan, and the bottom one there is of Augusta National. But I've been to the old
Oh
course in
wow.
Scotland, but I haven't been able to play yet. It's on the bucket list, Dave. So I'm
For
sure I'll
sure.
write about it or tweet about it or be on a podcast about it, talking about it at some point. But yeah, Scotland's great. My wife and I, we really enjoy traveling. We try to get away, once a year if we can, to maybe some sort of international destination or some sort of sunny destination if we can, squirrel away the funds for those types of things. But travel is one of our kind of passions, and it's one of the things that we hope to do more of in semi-retirement, and
Yeah.
kind of my whole financial independence, work on own terms. I can't see myself. I can't see myself stopping work at all. Mainly because
Work
I have those.
optional. You want to work
Yeah, work
optional.
optional. Exactly. Right. Financial independence, work on own terms. Right. So that work optional thing, I'll still want to work because I want to stay busy. I want to be productive. I
You
want
just
to.
want to do things.
Yeah, I want to do things right, and it's kind of just a little bit more time effort kind of balance, right? That I'm striving for, or at least what we've always been striving for. So I think those days are coming, which is awesome. But at the
Yeah.
same time, you need money to do the extras in life, right? It's not free or cheap to be hopping on a plane, or you know go to a Scotch tasting event or whatever it may be.
Or playing
Pick,
golf anywhere in the world.
or
Golf is
playing golf,
expensive.
even let alone in Ottawa, right? So it costs money to do
Yeah.
these things, and so we want to be able to have a little bit more kind of time, money balance, amongst everything, and we'll need a little bit of income to do those things, but hopefully we won't have to work full time for all of it. So yeah, travel's fun. Um, love to go internationally, to far off lands at some point, like New Zealand's on the list,
I've been
Africa's
to
on the
New Zealand.
list. Yeah, so love to go. Definitely looking at the Far East at some point. So yeah, it's a big world, and just only so much time and money, but hopefully we can make a better balance of that going forward. So yeah.
Nice. One quick question about Scotland, the old course. You said you haven't played it yet, but you have been there. Did you at least get a picture of yourself on the Swilken Bridge?
So I got a picture of myself on the Swilken Bridge, and I walked the golf course, and I've been on the golf course because I was there this past summer when they did the Open Championship.
Oh,
So I
awesome.
was actually there for the golf tournament for the weekend, and great experience, and nice little bucket list thing to do.
For sure.
Um, but yeah, St. Andrews is a beautiful, nice, small little university town, and the rest of the country is amazing. And yeah, it'd be great to go back and see more of Europe. We've been fortunate to be, to go to Italy and Portugal and Spain, and
Wow.
yeah, we just need a few more places to go, and a few more darts on the world map to hit and knock off.
Nice.
So yeah.
Okay, as a couple of Canadians, I guess we have to finish it off about talking about hockey.
Mm, I was hoping you'd bring that up. So
Go
let's see
for it.
your
What do you
hat.
want
What
to
do you
say?
think of your team this year?
Well, as most people know, my team is the Canucks, and I think it's been an extremely disappointing season. They went into the starting this season saying it was their mandate to make the playoffs, and now they're sitting there going, "We're just now we're looking at the lottery, hoping we can draft high." So this year has been not what was expected or planned.
No, I mean Ottawa, my team. I mean it's. I think the expectations were to probably sneak into the playoffs. It's looking pretty grim now, just because they're
Yeah,
they're still hovering around 500. But I got a lot of optimism in our team. We just got so many young guys that can really play,
yeah,
and having a couple of our forwards like Josh Norris been banged up for part of the year. Stutzla's been in and out a little bit. He's a very good player as well for our top end. And we got some veteran leadership like Claude Giroux and a few other guys right in the room
yeah.
that's been, I think, really really good for the team. So I have a lot of optimism. But back to your team, yeah, I think
It's been
Vancouver needs a
disappointing.
bit. Yeah, it's been disappointing. I think they probably need a bit of a reset. I think the biggest team that needs a reset or potential we'll see
Shake
what they
up.
do at the deadline. A shakeup. Well, just they need to be mindful of is you got a superstar in Edmonton and Connor McDavid,
Right.
and Draisaitl and some of those guys, and they got to get some of those leaders some help, because if you've got the leading scorer and the second leading scorer potentially on a hockey team and they don't make the playoffs or they just sneak in,
Yeah, you're
kind
doing
of
something wrong there, right?
yeah, shame on management. So I think that's where the pressure is. Ottawa, good growth story. Vancouver, you kind of know what you're getting. It's a bit of a rebuild, but I think the biggest team that's going to watch themselves a little bit is Edmonton. Toronto's
Yeah.
Toronto. They're a good team.
And
Montreal's
Winnipeg's
decent.
doing obviously great this year too. Like
Yeah, they're just
they've really come back from the season they had last year to really turn it around this year.
yeah. I think they're just the Winnipeg strikes me as just a very depth oriented team, right? They're not relying on Shifley or any of those guys to really knock it out of the park. They've
And
got a
good
lot of depth.
goaltending.
Strong goaltending helps, and they've also been a team for a few years, right? There's not a lot of moving parts. They haven't been bringing a lot of people in or shipping a lot of people out. So there's a lot to be said for team continuity. And then you see Montreal, Carey Price out injured, lots of kids, lots of young guys. So there's a lot of moving parts there. But yeah,
Mm-hmm.
I think the teams to watch for as we go into the playoffs, definitely Montreal. Toronto should make it. Shouldn't be an issue.
Yeah.
Um,
Winnipeg will make it.
Winnipeg and then you got Edmonton and maybe Calgary as well too, right? So we'll see. Yeah, have to
We'll
talk
see.
hockey. We're Canadians, Dave. So it's what we do.
It is what we do. So interesting finish off to this episode of the Passive Income Podcast. A little bit of scotch, a little bit of golf, a little bit of hockey, but definitely a lot of words of wisdom throughout this past hour of everything you have said, Mark, has just been great to listen to. So thank you so much for spending an hour of your time with me here on the Passive Income Podcast. And any final thoughts before we sign off?
Not too much. I just for those that haven't followed me on Twitter yet, please do. I really enjoyed interacting with Dave and his community that he's growing in terms of the Passive Income Podcast. We've got a great community of like-minded Canadians, but also Canadians. We like to
Americans,
interact
British, all
with
sorts of,
anybody, really. Yeah,
yeah.
exactly. Right. So, hit us up on Twitter. So I'm sure Dave will put all the notes together and the links for this, but it's at my own
Yep.
advisor. And then my website is myownadvisor.ca. I tend to publish weekly. It's still a personal journey, but I have lots of details around different types of investing. I have experts on, case studies, free giveaways, tons of other stuff that I rotate through every few months. So hit me up, and I look forward to kind of engaging with you there. So thank you.
Awesome. Again, thank you so much for being on this episode of the Passive Income Podcast. If you are still here nearly an hour later, you have to subscribe. Those are the rules. You're still here. Hit the subscribe button. I'm serious. Just hit the subscribe button.